Good morning and a warm welcome to our Q1 update on our China and China funds. Thank you for taking time to join us today. As the ancient Chinese proverb says, a wise man adapts himself to circumstances as water shapes itself to the vessel it contains. In today's session, we'll be discussing how China has been adapting to the ever-changing market and economy. My name is Dawie Karstens. I'm part of Prescient's distribution team, and I'm joined by Tian Pan from our Shanghai office in China. Tian is the head of product in the Prescient China team and will be leading today's session as Yang couldn't make it. We know that political news dominates the headlines and it can be easy to lose sight of market updates. However, we are excited to bring you an in-depth market update today. Despite the removal of strict COVID restrictions last year, Chinese inflation is still under 1%, coming in at 0.7% for March. We'll be discussing how China has been cutting interest rates and injecting cash into the system, while the rest of the world have been fighting inflation and hiking rates. As always, just bear with us if we do experience any technical difficulties. Please feel free to ask as many questions in the Q&A function. We've disabled the chat function on the webinar. We'll try our best to get to as many of them towards the end of the webinar. And then lastly, we have applied for CPD points. We will distribute the certificates once we do receive the certificates from the FBI. And with that, I'll hand over to you, Tian.
Thank you, Dawie, and morning, everyone. Thank you for joining us this morning for the China update. Not a super eventful quarter for China, but still a lot of events and a lot of positive developments on both the political front and on the economic front. Now I'll take everyone through what's been happening in China on this part of the world. So firstly, I think I want to go through a section that we like to term global cooperation, where the United States, especially for China, is becoming less and less of a focus due to sort of the negative impacts it causes for both sides. And with that, I'll actually start off with a slide on China-US relations. So we've actually seen the very muted developments on China-US relations throughout the quarter. There has been no significant bilateral exchanges. Still, we have seen a lot of sort of media publications, a lot of what we like to term political noise coming out of the US side, both from Secretary of State Antony Blinken and from Janet Yellen, pictured here on the slide. There has been a lot of willingness to try and get the two sides talking again, but unfortunately no meaningful exchanges. And I'll go through on the later slides to show everyone why that is the case, more because China has been very, very busy in terms of active foreign policy with the rest of the world, the entire world actually. The relationship between China and the US remains tense, and I think we've mentioned since quite a few quarters ago that we don't expect improvements on the bilateral political front in the short to medium term. We believe that the direction of the political relation between the two sides largely sits in Washington's hands because it has been the side that has taken a lot of the actions, for example, since 2017-28 trade war and then sanctioning a lot of the Chinese tech firms. China, unfortunately, doesn't really have much room to play with as it is the reactive party. So we do want to wait and see what will happen in Q2 and Q3. There may be some changes with the upcoming US elections, and we're hoping for positive developments in the next couple of quarters. So that's on China-US relations. Moving on to China and the rest of the world, what we've seen this quarter is just pure constructive and positive foreign policy. Firstly, I think what has made the headlines is China-France relations. We've seen Emmanuel Macron, French president, making a landmark state visit to China, and the two sides coming out with an unprecedented, in terms of length, a 51-point joint statement to promote many, many things, from, for example, political dialogue to economic exchanges to working together on global security issues. One of the things we saw, part of the joint statement, is that China and France, for the first time, will deepen military exchanges. So it sounds a little bit more scary than it is, but what we can expect from that is China and the French military deepening communication channels to avoid conflict in the Pacific Ocean, as there is French military presence sort of in and around China's coastal areas as well. So that is something that's very quite positive, because we know China is already touted to have military tension with quite a few of the American allies that are neighboring countries with China. So we see that as a positive. France, we saw Emmanuel Macron come out with a comment to say that Europe should have its independent strategy and not necessarily just follow the US in everything. And from a China perspective, we see that as very positive because it shows that France is willing to sort of assess a lot of its interactions with China independently. So, for example, President Macron clearly stated that in terms of 5G, in terms of their network infrastructure, they will not single out Chinese companies for discrimination, in inverted commas, and they will set standards that companies all over the world have to meet to participate in the local industry, security standards and commercial standards. So that's positive. Huawei is obviously the standout company that everyone is aware of, but overall we believe that is a very positive step for the entire Chinese industry that wants to expand their business and expand their interaction with Europe. So we believe that's a very good first step. The China-Europe Investment Pact, the deal that has been put on hold for almost 2 years now, we probably see this as a first step towards unfreezing that progress. And once that occurs, there will be bilateral economic activity who will be a positive for both sides. We also saw China placing a lot of airplane orders with Airbus as a gesture of goodwill. So overall bilateral relations between China and France and China and Europe as a whole continue to warm up. And that's a very positive, as China-Europe trade it's a big trade volumes, and that's positive for both sides. Moving on, sort of the smaller interactions, we saw Brazilian President Lula visit China also on an official state visit. 15 deals with between Brazil and China were signed, covering satellite technology, digital economy, renewable energy, etc. We also saw bilateral currency deals signed, where bilateral trade is beginning to be settled in both Brazilian real and Chinese yuan. So that's, again, another positive development, not as big as sort of the French deals, but positive in general as a whole. Smaller countries that visited: Singapore's Prime Minister Lee Hsien Loong, Malaysian Prime Minister Anwar Ibrahim, Spanish Prime Minister Pedro Sanchez, and EU Commission Chief Ursula von der Leyen. So all of these high-profile visits showing that China is actively engaging with the world. Unfortunately, just not the US at the moment, but China is actively engaging with the rest of the world, and that's a very positive sign for us. I think what we need to keep in mind is that bilateral trade between China and the US accounts for less and less of China's total trade. It's currently sitting around the 10% mark. So we think it's very prudent and very competent for China to be focusing on the rest of the world, which actually accounts for 90% of its overall total trade. Cross-strait relations, it's not necessarily foreign relations, but cross-strait relations between mainland China and Taiwan has been quite a flashpoint and has had a lot of media coverage throughout probably the past couple of years. What we saw during the quarter was, again, positive developments, because it's actually what happened in the quarter makes us believe that cross-strait relations have stabilized. So the risk of military conflict, the risk of economic sanctions between the two sides have reduced in our view. And the reason we say that is, firstly, former Taiwanese president and KMT leader Ma Ying-jeou visited mainland China for 12 days during the month of March. So why this is significant? He is the first leader of Taiwan, the first leader of the KMT, the Kuomintang, or the Chinese Nationalist Party, to step foot on mainland China since 1949, since the Chinese Civil War began. And this shows a strong positive gesture of promoting peaceful dialogue. And that is exactly what he said when he visited mainland China. So this shows us there's enough of political will from within Taiwan to make sure that the conflict between Taiwan and mainland China does not get out of hand, which shows us there's enough competence to avoid a second Russia-Ukraine situation between mainland China and Taiwan. So we view that as very, very positive. The entire trip was hailed as a success by a lot of the commentators within Taiwan and within mainland China. So we're very happy about that. Current Taiwanese President Tian Pan had a very, very quiet trip to the US. So they did go and visit official diplomatic allies. And on the way to visiting those allies, typically the Taiwanese president would transit in the US to meet up with US officials. What we saw, so prior to the trip, we were actually quite worried of a high-profile visit by President Tian Pan in the US that would cause more political backlash from China. What we actually saw was very encouraging. So we saw that it was a very quiet trip. President Tsai never met with any significant Democrat leader, at least not publicly. She only met with Republicans, and that gives us a clear indication that the White House actually told, or at least all of the significant Democratic leaders, not to create a political issue out of the visits. Tsai did meet with Kevin McCarthy, the Republican House Speaker, who previously mentioned that he would visit the island of Taiwan. And that was one of the major risks that we saw that could cause more military exercises, more tensions. And the fact that he met President Tsai in Los Angeles means that we no longer expect a physical Taiwan trip by Speaker McCarthy. And that, again, is very positive. So it's all of these actions sort of tones down the political, intense political sort of situation between the two sides, and everything so far we are seeing it as peaceful, positive developments. So overall, on the politics and geopolitical front, we think Q1 has been fairly positive, and we're very comfortable heading into Q2 on the Chinese front, at least. Looking at actual economic numbers, everything is very positive, and I think I'll move on to the next slide to just let the numbers do the talking. So firstly, China's GDP growth doing very well, beating expectations, hitting a Q1 number coming out at 4.5%. Q2 is expected to even be higher. So median expectations anything between 6 to 8%. So the chart on the right-hand side here, we're seeing all of the banks, the black dots were the previous projection of Chinese economic growth. The blue dots revise expectations. So we're seeing all major investment banks revise the economic projections for China upwards. We need to keep in mind that China's economy is sized at over $18 trillion. So $18 trillion growing at around 6% is going to carry global economic growth for 2023, especially with the financial crisis and the low expected growth, high inflation in developed markets. If we look at China's overall PMI numbers, also very, very positive. China's manufacturing PMI actually quite flat, but also above the 50 mark. But what makes the composite PMI very high, or pushed composite PMI higher, is non-manufacturing service PMI. So we think that's very positive. The service sector is a massive employer in China. It really gathers overall market sentiment in terms of the physical economy, and we're very happy to see that number consistently stay positive, actually climbing higher. The numbers are pretty high, so over the next few quarters, we do expect the numbers to come down slightly and normalize, but as long as it's above the 50 mark, we are quite comfortable that the economy is in positive hands. So moving on to valuations, the Chinese market consistently and continues to be cheap, both in absolute terms and relative terms. So the PE ratio multiple on this slide has increased compared to a couple of quarters ago, and that is due to new earnings coming through from 2022. As you'll remember, China went through strict COVID lockdowns throughout 2022, so we're only starting to see the earnings numbers now, and earnings are depressed. So we are seeing declining earnings We can see on this slide the green bar on the chart, the green bars on the chart, earnings declining compared to a couple of years ago. And we're seeing, if we look at the orange line on the chart, earnings multiples are also declining. So both in terms of earning multiples and actual earnings numbers are depressed currently, which makes us view China as very attractive from an earnings and valuation perspective for going forward over the next investment cycle. We believe from current valuations, we can generate very strong real returns going forward. And I think the last slide in terms of numbers from a South African investor perspective, with our core portfolios being in the JSE, we typically like to allocate offshore exposures split between MSCI DN, for example, developed markets, and MSCI EM. But the problem with a sort of basic allocation to MSCI emerging markets is that it is highly correlated to the JSE all share. So that's why we believe China, based on correlation data, is probably one of the best diversifiers for South African investors. So you can see the green bar on the left, that's China CSI 300, China A shares, and MSCI China is China offshore. It has companies like Tencent, Alibaba. Tencent obviously highly correlated to the JSE all share, whereas the CSI 300 doesn't have that issue. That's why we believe going forward, CSI 300 will continue to be probably one of the best diversifiers for South African-based portfolios and global-based portfolios. Okay, with that, I'm going to move on to sort of the positioning and performance of our China Balanced Fund. This quarter is very special because as at the end of March, we've hit our 10-year milestone since launching the Prescient China Balanced Fund. So a quick recap of the numbers. Cumulatively, since March 2013, over the decade, we've done 127% cumulatively in dollar terms. This is in dollar terms after fees for the fund. The pure equity CSI 300 total return index is 78%. Our reference, sort of your standard static balanced fund in China, would have done 65.8%, and China CPI plus 3 did 50%. So we significantly outperformed our benchmark. We delivered strong real returns around CPI plus 7%, China CPI plus 7% per annum throughout the decade. And we're very proud of the results. If we look at this line chart, we were actually very surprised to see these numbers when we did do the work. Overall, as I mentioned earlier, we returned 127%, but we managed to beat pure equity indices. So we managed to beat MSCI China Total Return, the CSI 300 Total Return Index, and we managed to beat MSCI Emerging Market Total Return by almost 6 times. So our returns were almost 6-fold of MSCI Emerging Markets. So that's really something that we are very proud of. We can't say that for the next decade we'll beat pure equity indices because the fund is not benchmarked towards that. But our processes, both in terms of our dynamic asset allocation and in terms of our pure asset selection process, both in terms of equities and fixed income instruments, have clearly worked out well, and we continue to enhance our processes so that we can deliver for our clients over the next decade similar type of strong real returns. And we believe from a current sort of perspective in terms of valuation, we are quite confident to be able to deliver strong real returns over the next investment cycle within our China balanced strategy. So we thought with the decade having gone past, we wanted to relive the journey a little bit, just to get everyone refresh everyone's memory over the past decade, what we have been through, because currently it seems like there's a lot of global uncertainty. But for us, having been in China actually since 2009 and launching the fund in 2012, 2013, we've seen a lot of these things play out again and again. So firstly, back in 2012, 2013, when we first launched the fund, surprisingly, there was also a lot of concern on Chinese properties and Chinese banking sector. So we went back to find some news headlines. This is from Reuters. Chinese banks were feared to have a lot of the property debt. The Chinese property sector back in 2012 was feared to be on the brink of a collapse. Yes, we did go through a bit of a financial crisis from about 2020, 2021 onwards. But 2012, people were already starting to say the Chinese properties are overvalued, there's a bubble, and there's going to be a crash. So these are some headlines, and where we sit now, even with sort of a mini property crisis that happened over the past couple of years, Chinese properties are still up from 2012 levels, up more than 100% on average. In some instances, depending on which cities you look at, up more than 200%. And the banking sector is as strong as ever. The banking sector was actually very good at controlling sort of their exposure to the risky property sector. There were obviously losses in the offshore property bond market, but in terms of Chinese banking sector, very, very stable, much more stable than their Western counterparts. We saw with Silicon Valley Bank, etc., and Credit Suisse in the West. So this was something that happened back in 2012. If we look at something that happened in 2013, there was an anti-corruption campaign that analysts in the West, or the media, I want to say analysts, media noise at the time said anti-corruption campaign would kill consumption in China because there's a lot of money, grey money that flows through corrupt activities, then funnels itself through to buying luxury goods that would be positive for companies, for example, like LVMH and Richemont. What we saw at the time was there was a temporary drop in consumer spending after the anti-corruption crackdown, but the medium to longer term impacts subsequent to that was a better functioning economy that helped to grow China's middle class. And China's middle class overall, the absolute large numbers in people included in luxury consumption made sort of overall consumption of luxury goods much, much higher than the previous corrupt money could ever have done. So overall, again, some short-term pain, which led to long-term prosperity in terms of China's anti-corruption campaign that began all the way back in 2013. The anti-corruption campaign continues, and now and again, we still see media headlines talking about anti-corruption campaigns, regulatory changes that's killing off industry. And we just like to show these headlines to remind everyone that this is not something new in China. We always go through this. What we want to look at is the logic behind the campaigns, the logic behind the regulatory changes, if it creates a better long-term sustainable environment for the entire industry. And if it is, any pain that we get will be for the short term and it will be positive for the long term. And so far, what we have seen is all positive for long-term sustainability. So that's why we're very confident for the next decade of investments in China as well. China's equity market crashed in 2015. There was quite a bubble back then. And yeah, there was fears that the equity markets would never come back. But now we are higher than the high points of 2015. The market has recovered. It did take some years. The market has matured since then. And there's a lot more institutional participation. Obviously, Prescient is one of these institutional participants in the market in China. And we have seen market volatility in China overall sort of reduce. And that's a positive sign. It's a sign that the market is maturing. And overall, we are quite happy with the way that the market is developing. So we also, comparing to current events, we've also seen sort of a slow decline in markets, obviously a sharp decline last year and a quick recovery since November due to opening from COVID. Market volatility is nothing new in China, but overall volatility is reducing. The market is maturing, and we believe the market will be strong moving forward. And lastly, I think the current sort of China-US tensions began all the way back in 2017 when President Donald Trump first came into office. A trade war began, sanctions on Huawei happened. Firstly, it was sanctions on ZTE, and then Huawei CFO Meng Wanzhou got locked up in Canada on an high-profile extradition case that ended up with her being released only a couple of years later. All of these things are nothing new. We've been through all of this time and time again. It's not positive, so don't get us wrong. It's certainly not positive for the market, but it's something that occurs. It's something that we view as cyclical and something that we are navigating the markets while keeping in mind of. This is something that we don't expect to go away. We expect this to be the new normal between China and US relations, but it doesn't mean that Chinese markets are uninvestable because of something like this. If we look at the numbers of the CSI 300 since President Trump started the trade war, during his 4-year term in office, the CSI 300 actually grew by more than 80% in US dollar terms through his 4-year term in office. If we look at the trade war again, bilateral trade between China and US hit almost $700 billion last year. And that is on the back of the trade restrictions, on the back of tech restrictions. So without these, bilateral trade would be higher, but even with all of the restrictions, bilateral trade is still growing. And it shows the resilience of the Chinese economy and the Chinese markets. And that's what's very encouraging to us. And that's why we believe there's a lot of strength in the Chinese economy and the Chinese financial markets. So overall, yeah, I think the past few slides, what we wanted to reiterate is that noise is nothing new. Media noise will always be there. We've seen the cycle before, and we will continue to monitor all of the noise to filter out what is really noise and what is fact. And that's how a quantitative investment process works, and we'll continue to try and deliver strong real returns for investors going forward. In terms of balance side positioning, currently on this chart ends at end of March. Sentiment has been very, very positive up until then. Up until end of March, we were maximum equity allocation, about 90%. Actually, just last week, sentiment has toned down quite a bit, so we have reduced our equity allocation slightly, but we do manage our asset allocation very, very actively. We adjust on a daily basis. So we move very, very quickly to try and capture as much market upside as possible while reducing market downside. So currently, overall sentiment and our equity allocation reflecting a positive view on the market. Moving forward, we continue to have derivative structures in place to get market upside exposure while limiting downside. So one of the structures we have on the Hong Kong stock portion of our portfolio is that we are protected for up to 25% drop in the market while gaining quite a lot of upside exposure via derivative structure. Obviously, we had to give up some of the outperformance by paying for the option structure, but this is one of the ways that we gain alpha opportunities in the fund without having too much downside risk. In terms of overall performance, I did mention earlier, we had our 10-year track record overall since inception. We've done about CPI plus 7, China CPI plus 7 after fees. Over the recent years, over the last couple of years, markets have been a bit tough, so we've underperformed our CPI target, but still outperforming the reference 65-35 benchmark over 3-5-year periods. So still fairly strong in terms of Morningstar rating. We've just received our 10-year rating, so we are now rated Morningstar 5-star for both 3, 5, 10-year and overall rating. So we're very proud of that, and we will obviously continue to work very, very hard to maintain those ratings and continue to deliver consistent returns to clients. So in summary, valuations currently are very, very attractive, both relative to other emerging markets and also relative to developed markets, such as the US and Europe. The economy is recovering fast. We've seen it in the GDP numbers. We've seen the revised higher expectation numbers for the GDP. That's why we are overweight in terms of equities for our portfolio. Fixed income, we are largely in very, very much risk-free assets, and we will likely, where possible, increase our equity exposure again as soon as our sentiment models give us the indication. Derivatives, I mentioned, we continue to use that to protect the downside while gaining upside, and we will continue to manage our asset allocation very, very actively on a daily basis. So overall, we believe right now, given current valuations and current outlook, it's a very good time to add China exposure via China balance strategy currently. And I think with that, I will end around here and open up for questions if there are any questions.
Thanks, Tian. Yes, there's a couple that's come through. I think let's start with You almost ended with it, but how do we know when it's a good time to allocate to China, and why invest in one of our funds instead of a China fund that picks stocks, so a more active stock picking fund?
Oh, thanks, Ari. That's a good question. So timing is always something that everyone struggles with. And I think if we look at, let me go back to our 10-year chart. So if I look at our chart, this is actually something that we discuss quite a lot with clients. So if you guys look at the red line on the chart compared to all the other lines, why we believe allocating via Prescient China, or Prescient as whole, our overall investment philosophy is the same across the group, is that our alpha is typically gained consistently over a long period of time, and you can see that exactly from the line chart. So our CPI plus 7 over 10 years after fees didn't all come through a 3-year period out of the 10 years. How we delivered that, it was consistently generating that number, consistently generating alpha, adding bit by bit, year after year over the 10-year period. So in terms of how our quantitative process works, how our alpha process works, it actually doesn't matter as much compared to other investment styles that hold more concentrated portfolios, and typically those strategies that may have index plus 20% the 1 year and then index minus 10% the other year, to give you an overall index plus 10%, but your experience will be very different depending on when and where you enter the product. In terms of our Prescient China balance strategy, you don't have that problem, because typically we are able to generate consistent alpha every single year. So obviously there is the risk that there will be a market downturn, but in terms of alpha, in terms of real return, if we look at through an investment cycle of 3 to 5 years or even longer, we are generally able to quite consistently generate alpha and generate a good real return. So the entry point is not extremely difficult in terms of our strategy. Although saying that, right now we believe overall market valuations are very, very attractive in China right now. So we do think right now is a good entry point, at least to begin allocating some more money into China and into China balance.
Thanks, Tian. I think you almost answered the next question. There's the question that came through about our views on Alibaba, and can you comment on the weakness and opportunities of the share? I'm specifically asking it just to bring us back to our process.
Sure. So Alibaba is actually something that's talked about a lot. Alibaba, we would say currently it's a little bit of an anomaly within the market. We do have some exposure of Alibaba via our Hong Kong share option, which gives us upside but not the downside. And there's reason for that is Alibaba's valuation is very, very attractive right now. If we look at their financial statements, if we strip out the cash they have on hand, their PE multiples literally in single digits. If we look at their original IPO price, when they originally listed in the US, it was around $90-something. I can't remember the exact number. Currently, as we sit today, I think we close at about $84. So we are cheaper than the IPO price on Alibaba. But the only difference is that Alibaba now has around 11 times the revenue compared to when it IPO'd, and also around 11 times the profits compared to when they IPO'd. So it gives you an idea of how cheap the valuation is of Alibaba. Why it is so cheap and consistently becomes cheap when you look at Alibaba compared. So part of it is sort of the overall market sentiment within the Chinese offshore sort of market pool, where the overall market has dropped. But we think a significant part, we can tell, is from the selling of major shareholders. So we saw SoftBank, which originally held over 30% of Alibaba shares. They have been consistent sellers. They wanted to get out the exposure. So you have a major shareholder selling. So basically at all prices that people want to buy in the market, simple supply and demand, you always have a seller, which makes it difficult for the share price to climb up. But SoftBank is nearing the end of its selling. I think their target end exposure to Alibaba is somewhere between 3 and 4%. if I'm not mistaken. So they're almost there. And once consistent major shareholder selling stops, we expect valuations to normalize. Why we say Alibaba is extra depressed is when you compare Alibaba's share price movements to Tencent, which hadn't had a major shareholder's consistent selling. You'll see relatively Alibaba has done quite a lot worse, although Tencent might be next because Process has announced that it will sell quite a lot of Tencent shares. Depending on the way they sell in the market, it might impact the Tencent share price now worse than Alibaba. So quite a lot of factors, quite a lot of factors, but overall, Alibaba, we believe its valuation is very, very attractive, and having or not having, but because we live in China, you'll actually see that every single one of us at the office, we cannot live without something that's from the Alibaba group, using something that's from the Alibaba group daily. It's sort of part of everyone's daily lives. So we don't believe Alibaba is going anywhere. The splitting up of the business to extract value into via 6 different units, we still think that's positive, but that'll take time to come through as the individual business units IPO. But overall, we are obviously positive on Alibaba over the long term, although we do acknowledge that there will be continued short-term selling pressure, mostly due to large shareholder selling.
Thanks. I'm going to ask one more question, but it's sort of 3 combined into one. So how would you view investing in China going forward, given the current geopolitical situation? And maybe focus a little bit more on Taiwan. Should investors be worried about the current situation? And then is there a risk of investors getting the money out of China if something does happen?
So, current geopolitical situation is obviously very concerning because we see a lot of media coverage on it. But we've consistently been saying we need to filter through the noise. So a lot of the hype doesn't end up materializing, especially so when I mentioned earlier, if I move up to the slide of cross-strait relations, there was, so prior to specifically on the issue of Taiwan, prior to President Tsai Ing-wen's US visit, there was a lot of hype that she'll meet top officials from the Democrat Party. She'll meet potentially someone from the White House. She'll have a high-profile meeting with Kevin McCarthy. And even prior to that, Kevin McCarthy was stated to visit Taiwan. So we all knew what happened when Nancy Pelosi last year visited Taiwan. There were major military exercises. There were major sort of communication channels between China and the US that were cut off, cooperation that was cut off. So it caused a lot of political backlash. And this time, prior to President Tsai Ing-wen's trip, there was a lot of hype, expecting things to get even worse than after Nancy Pelosi's Taiwan visit last year. What we actually saw during March, during the trip, was something that was completely opposite. So the saying goes, actions speak louder than words. So this is a clear case of media hype, media noise, over-exaggerating things. And when the actual trip happened, Tsai Ing-wen never met with any meaningful official, never met anyone from the White House, and only met mostly Republicans who are not running the US currently. So all of this shows the political will from all sides, Taiwan, US, China, that they don't want the political situation to get out of hand. But that doesn't mean the political situation is not tense. So we believe it continues to remain tense, but nothing is getting out of hand. So not too worried about that. In terms of investing in China, getting money out of China, Prescient is registered as a qualified foreign institutional investor in China. So that is similar to foreign investors investing in South Africa. So China's got strict capital controls, but because Prescient is registered as one of these institutional investors, we are able to move capital freely in and out of China with no restrictions. So we are whitelisted. We don't have any capital controls applied to us. So that is obviously one of the major advantages of investing via Prescient rather than investing with your own money transferring money to China, investing in the stock market. So that is something that is an advantage. We don't believe there will be any restrictions on foreign investments in China in and out. What we are seeing and what we are hearing from official government communications that China will continue to open up. And we are quite comfortable, having been here for 15 years, seeing the consistent opening up of the market. We don't expect the direction of that to change. So overall, the geopolitical tensions remain, but that means that the markets will become less and less correlated. So especially as South Africans, we don't want to pick sides. So, I mean, as part of a globally diversified portfolio, we wouldn't recommend anyone to completely ignore China, nor completely ignore, for example, the US markets. I think allocations to both helps diversify the entire portfolio. And that would be the approach that we would recommend.
Thanks, Tian. I think we'll finish the questions there. So with China now open again, we are planning on hosting clients again for a China investor tour. So if anyone is interested in joining us for that, please get in touch with us as soon as possible. The space is very limited for that. And thank you again all for joining today. We hope that you found the session insightful, and we do look forward to connecting with you all again soon. Have a lucky week. Bye.